Well, the end of this month marks the deadline for homebuyers to take advantage of the housing tax credit, which is worth up to $8,000. The question now is what will happen to the market in the days leading up to the deadline and then after the credit ends? We're asking one of the most accurate housing economists out there, according to data compiled right here at Bloomberg. That's David Resler. He's chief economist at Nomura Securities. David, when we checked in on the markets, I noted that manufacturing number in the United States really coming in, showing some optimism about where the economy is headed, perhaps. Yet the question now is, will housing be a drag? Will it counter that manufacturing buoyancy we may start to see right now?
I don't think it's going to counteract the buoyancy in the manufacturing sector, but it's not going to be a big boost to the economy over the next year or two. We're going to see improvement in housing activity. It's going to be a contributor to GDP growth, but we're going to be operating at levels and producing volumes of new homes that are unusually low for any time of an economic business cycle. In fact, we don't think we're going to get back to a typical low point of previous expansions on housing starts until the end of 2011. So we think there's going to be some gradual improvement, and it's going to be growing, but it's not going to be anything like we saw in the early part of this past decade.
Now, the housing tax credit here is how we led into you, and the conversation that's now circulating among some, including notably Robert Schiller, is the question of whether or not the tax credit can be taken away, whether it needs to be extended again and again here. Almost it's sounding like housing heroin, we've been calling it here, that there's an addiction to these tax credits, the addiction to some help from the government to keep momentum going. Is that your take?
Well, I think it is my take. Like many of the other government programs have been put in place during this crisis, we need to learn to wean ourselves from these temporary and transitory programs that had a very specific goal when they were put in place. In my judgment, the housing tax credit was not particularly well designed to have a lasting impact on housing to begin with, and I think we're not really helping matters very much to keep it in place. As a matter of fact, the expiration of the first round of that tax credit, which everyone believed was going to end in last November, and then it was reinstated and extended to the end of April. I think that since the first wave of it ended, we haven't seen a great deal of evidence that it's provided much of an added lift to home sales in the last few months. That's partly because the data have been weak. It's kind of hard to pull out what effect that you might be getting from the first-time home buyers, first-time and now second or third-time home buyers tax credit.
It seems like, David, that you almost need to have a psychology degree or sociology degree right now to be in the economic forecasting business when you look at housing, because you hear that people who have houses on the market might be trying to compete on price with those expectations of where pricing would be if that tax credit was not there, right? That it would pressure prices almost because people are expecting that.
Well, I think it's kept some upward pressure. It's kept prices higher than they might have otherwise been, but it's also delaying the adjustment that we might need to have to fully correct the housing market and put things back on a sustainable pace.
All right. David, I'm sorry, we're going to have to leave it there. We have to take a break. David Resler of Nomura Securities.